In 2024, the motor coach industry moved over 600 million passengers across the United States. That's more than Amtrak, more than most airlines. The whole industry generated $158 billion in economic impact and supported nearly 900,000 jobs. That same year, the largest privately owned bus company in America filed for bankruptcy with nearly $200 million in debt, while still running thousands of buses, while passengers were still buying tickets. So what is actually going on here? Is the bus business a goldmine that nobody's talking about, or is it a trap disguised as an opportunity? The answer is both, and understanding why is exactly what we're going to do today in the economics of owning a bus. Most people have no idea what a commercial motor coach actually costs to buy, and that's part of why this industry is so misunderstood. A new Boeing 737 starts at around $100 million. A cargo ship can run you anywhere from $50 million to over $200 million. But a brand new full-size motor coach, the kind that seats 56 passengers and hauls them from New York to Boston or Chicago to Detroit, starts at roughly $450,000 to $500,000 for a base model and can run up to $600,000 or more with premium specs. That's it. For less than the price of a house in parts of California, you own a 45-foot vehicle that can legally carry 56 people anywhere in the country and charge them for the privilege. And the used market makes it even more interesting. A 5 to 8-year-old coach in solid condition might go for $150,000 to $250,000. A 10 to 15-year-old workhorse, you're looking at $40,000 to $60,000. The entry point to this industry is genuinely low by the standards of any serious commercial asset. So that's what it costs. Now here's what it can make. Charter bus rates in the US typically run between $1,300 and $2,200 per day for a full-sized coach. Corporate clients, sports teams, concert tours, universities running shuttle programs, they often pay at the higher end of that range or beyond. Premium operators on in-demand corridors command even more. Run the math. A bus that's actively generating income 5 or 6 days a week at $1,500 to $2,000 a day is pulling in somewhere between $375,000 and $600,000 a year in gross revenue, on an asset that cost you $500,000 to buy new. That's the pitch. And it's not wrong. The problem is what happens after the pitch ends. There are really 3 ways to own a bus and extract income from it, and they have completely different risk profiles. The first is to own and operate. You buy the coach, hire the drivers, build out your routes or your charter business, handle the DOT compliance, the insurance, the customer service, all of it. This is the highest potential return and the hardest way to get there. The US charter bus sector reached about $5 billion in revenue in 2024, with over 6,300 companies operating nationwide. But this is a real operating business. There's nothing passive about it. The second approach is leasing. You buy the coach and lease it to an established operator under a fixed monthly contract. They handle the drivers, the fuel, the logistics. You collect a check. This is where investors who want the asset without the operation tend to live. It's essentially being a landlord where the highway is your property and the operator is your tenant. The third is the secondary market. Coaches age out of premium service after about 12 to 15 years. Top operators won't run them on flagship routes anymore. But that doesn't mean the asset is dead. Church transportation groups, regional tour operators, university fleets, they absorb these older coaches and put them back to work. A 15-year-old coach in decent condition can still fetch $80,000 to $150,000. And when it's truly done, the parts, engines, transmissions, HVAC systems still have value. The bus doesn't go to zero. Now here's the thing most people considering this industry don't think about. The lease model sounds boring. It is boring. That's exactly why it works. An operator paying you $6,000 to $8,000 a month in a fixed lease on a coach that cost you $500,000 is giving you a 14 to 19% gross annual yield before financing. In a market where real estate investors are fighting over 5 to 6% cap rates, that number looks very different. But boring doesn't mean safe. Here's the thing about buses that nobody tells you before you start thinking about the numbers. The road destroys equipment. A commercial aircraft operates in relatively clean conditions. Its tires touch asphalt for a few minutes per flight. A bus operates in a constant war against physics. Potholes, hard braking, summer heat, winter cold, curb strikes, and drivers with varying levels of care. Engine overhauls can run $20,000 to $40,000. Transmissions cost $15,000 to $25,000 to replace. A motor coach runs on 10 tires, and you replace a full set every 60,000 to 80,000 miles on active routes. Add it all up, and maintenance can easily eat 20 to 30 cents of every revenue dollar if the vehicle isn't looked after properly. And this becomes a specific problem in the lease model. If you lease your coach to an operator and that operator defers maintenance to protect their own margins, you inherit the bill when the lease ends. The contract is everything. If it doesn't include a monthly maintenance reserve requirement, that oversight will cost you. Then there's the driver problem. The commercial transportation industry has been dealing with a persistent shortage of qualified CDL drivers for years. Getting a commercial driver's license takes time and money. Retaining those drivers is even harder. The turnover rates in commercial transportation are brutal. When Coach USA filed for bankruptcy in 2024, they specifically cited driver shortages as one of the factors that hampered their recovery from the pandemic. This isn't a footnote, it's one of the core operating challenges of the entire industry. And then there's insurance. Commercial vehicle liability insurance has been climbing steadily for years. A single serious accident can trigger claims that reshape your cost structure overnight. This is a line item that operators underestimate constantly and regret immediately. But the biggest risk in this industry isn't maintenance costs or insurance. It's something that can wipe out your income without any warning at all. In June 2024, Coach USA, the parent company of Megabus, one of the most recognizable bus brands in America, filed for Chapter 11 bankruptcy. The company operated 2,070 buses, served 38 million passengers a year across 27 locations in the US and Canada, and had been running continuously for years. It entered bankruptcy with $197.8 million in debt. How does a company that size, moving that many passengers, end up bankrupt? The short version: they were acquired by a private equity firm in 2019 for $270 million, mostly using debt. Then COVID hit and bus ridership collapsed by 90% almost overnight. By 2021, they were operating at 26% of pre-pandemic passenger levels. By 2023, they had only recovered to 45%. Meanwhile, the debt they took on in the 2019 buyout kept accumulating interest. The fixed financial obligations never paused. The revenue did. And that is the core lesson of this whole industry. The bus business has enormous fixed costs: financing, insurance, compliance, staff that do not care what is happening in the world. When ridership collapsed, those costs kept running. When Coach USA needed relief, there was none because the debt structure left no room for it. For an individual investor thinking about owning a bus or a small fleet on leverage, the Coach USA story is not just interesting history, it's a warning label. If the largest privately owned bus company in America couldn't survive the combination of a demand shock and fixed debt obligations, the math is even less forgiving at a smaller scale. This is also what happened to ordinary operators during COVID. Bus ridership dropped by more than 80% in 2020. Operators stopped paying leases. Legal enforcement was frozen by emergency statutes. Investors who thought their contracts were ironclad discovered that emergency government powers operate outside of contract law. The bus you own is not just subject to market forces, it's subject to whatever the government decides in a crisis. That's not a hypothetical, it already happened. There's one more risk that this industry doesn't talk about loudly enough, and it's probably the most structural of all. California's Air Resources Board has already mandated that all new transit bus purchases in California must be zero emission by 2029, with full fleet electrification by 2040. Multiple other states are adopting identical standards. This isn't a proposal, it's law. Now, the complication for diesel motorcoach investors is this: unlike a building you can renovate, a diesel powertrain cannot be converted to electric. The chassis, the fuel systems, the electrical architecture, they are fundamentally different machines. Which means every diesel coach you buy today is, from the moment of purchase, on a countdown to regulatory obsolescence in an expanding number of states. The good news is that electric bus technology is improving fast. Battery prices have been falling dramatically for years, and the gap between diesel and electric total cost of ownership is closing. Some European markets are already reporting electric bus TCO parity with diesel. American federal incentive programs have been funding electric fleet transitions at significant scale. The complicated news is that for private investors not operating large institutional fleets, access to those incentive programs is limited. The charging infrastructure requirement is real, and the timeline for diesel phase-out in major markets is fixed and firm. The operators who navigate this transition well will own the next decade of this industry. The ones who keep buying diesel coaches as if the regulatory landscape isn't changing are building fleets that will be stranded assets before those assets finish depreciating. Let's put this together in plain terms. Say you buy a 5-year-old MCI motor coach for $250,000. You put 25% down, that's $62,500, and finance the rest at around 7 or 8% interest over 5 years. You lease it to an established charter operator for $6,500 a month. Your annual gross income from that lease is $78,000. After debt service of roughly $23,000 a year and a $10,000 annual maintenance reserve, you're looking at about $45,000 in annual net cash flow on $62,500 of your own money. That's a cash-on-cash return of roughly 72% in a healthy market with a creditworthy operator on a coach that's well-maintained and running. That number sounds too good. And there's a reason it sounds too good. It assumes everything goes right simultaneously. The operator pays, the coach runs, no major mechanical failures, no regulatory surprise, no pandemic, no driver shortage forcing the operator to park buses. When it works, it really works. When it doesn't, the leverage that made the numbers look incredible is the same lever that accelerates everything to the downside. The charter bus industry in the US had $5 billion in revenue in 2024. More than half of operators surveyed said they plan to expand their fleets. Motorcoach sales exceeded 2,000 units for the second consecutive year. Demand for group travel, corporate shuttles, university transportation, and event services is growing. The underlying business is real. The question isn't whether you can make money in this industry. Plenty of people do. The question is whether you understand what you're actually buying. A motorcoach is not a passive investment. It's not a treasury bond that happens to have wheels. It's a commercial vehicle operating in a regulated industry with real operating risks, real counterparty risks, real maintenance requirements, and a real regulatory transition happening on a fixed timeline. It rewards people who understand commercial transportation, who write contracts that protect them from operator negligence, who keep leverage conservative enough to survive a 6-month revenue gap, and who are already thinking about what their fleet looks like on the other side of the diesel phase-out. It punishes people who run the lease yield numbers, see a big return figure, and assume the risk side of the equation will work itself out. Coach USA saw that risk side. 38 million passengers a year and nearly $200 million in debt. And it still wasn't enough margin to survive when the world changed. The road is genuinely in front of you, the numbers can work. But this is a business, not a shortcut.